Hello everyone, welcome to the 45th episode of me learning how to trade using Forex. So in the previous episode we covered the relationship between margin and leverage. We made notes on this, we know that leverage is a ratio, la da 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 da, and made notes on all of that. The differences, was it Forex margin versus securities margin, made notes on that as well. And now we're currently doing margin jargon cheat sheet. So yeah, let's get started. As you dive into the world of margin trading, it may feel like you have to learn an entirely new language to truly understand what's going on. Just as with any specialized area, margin trading comes with its own terminology and jargon. Here's a handy cheat sheet to the most common terms you may come across in your trading platform. Want a printable version? Here's a PDF version of the cheat sheet below so that you can download and print. Right, so margin definition. Margin is the amount of money you are required to deposit with your trading platform in order to order and maintain positions in the Forex market. Margin is used as collateral to ensure you can cover any losses you might incur on your positions. Yep, so we've got that. Is there a need to make notes on this? Sure, why not? Margin, the amount of money you are required to deposit with your trading platform to maintain positions in the Forex market. Margin is used as a collateral to ensure you can cover any losses you might incur in your trade. Okay, yep. Leverage. Leverage is the ability to trade a large amount with much a smaller account in your account. Okay. The ability to trade a large amount of money using a small amount of money. Very small, using a small one in your account. Unrealized profit loss. P/L. Current profit or loss held in your open positions. Current profit or loss held in your positions. In your open positions. Also known as floating P/L. Floating profit loss. Also known balance. Total amount of cash you have in your trading account. Total amount of cash you have in your trading account. If you have an open position, even if it has a floating profit or loss, your balance is still the same before you open the position. But once you close the position, the profit or loss will be added or deducted from the balance, and this will be your new balance. Only changes after the position has closed. Also called account balance, cash. Margin requirement. Margin requirement is the amount of margin required to open a position. It is expressed as a percentage of the full position size or notional value of the position you wish to open. The amount of margin required to open a position. Expressed as a percentage of the full position or notional value of the position you wish to open. Or notional value of the position you wish to open. Required margin. Is the money that is set aside and locked up when you open a trade. Money which is set aside and locked up when opening a trade. For example, if you open a 10,000 mini lot position with a required margin of 2% or 50 to 1 leverage, $200 will be locked up during the duration of the trade. This 200 can't be used to open other positions as long as the trade is open. Once you close the trade, the 200 margin will be released. Also called entry margin, initial entry margin, maintenance margin required. MMR. How to calculate per position. If the base currency is the same as your account's currency, required margin is notional value times margin requirement. If the base currency is different from your account's currency, required margin equals notional value times my margin requirement, times by exchange rate between the base currency and account currency. That should have said account currency, but it says accounts current. Right, okay. Used margin. Used margin is the minimum amount of equity that must be maintained in a margin account. The minimum amount of equity that must be maintained in a margin account. Minimum amount of equity that must be maintained in a margin account. This is the total amount of margin currently used to maintain open positions. The total amount of margin in use to maintain open positions. Also called margin used, maintenance margin requirement, and total margin. How to calculate used margin is simply the required margin for all open positions. So used margin is total required margin for all open positions. Right, okay. Equity. Equity is your account balance plus the floating profit or loss of all your open positions. Your account balance plus the floating profit loss of all your open positions represents the real-time value of your account. Also called account equity, net asset value, net equity. How to calculate. If you have open positions, equity equals balance plus floating profit or loss. If you do not have any open positions, equity equals balance. Free margin. Free margin is the money that is not locked up due to an open position and can be used to open new positions. Which can be used to open new positions. When this value is at 0 or less, the margin warning is triggered, and additional positions cannot be opened. Also called free margin, available margin, usable maintenance margin, available to trade. How to calculate? Free margin is equity minus used margin. Margin level. Margin level is a ratio between equity and used margin. Between equity and used margin. It is expressed as a percentage. For example, if your equity is 5,000 and the used margin is 1,000, the margin level is 500%, also called margin indicator. How to calculate? Margin level is equity divided by used margin times by 100%. Margin call level. Definition. The margin call level is a specific level percentage where if your margin level is equal to or below it, you won't be able to open any new positions. Your trading platform determines the margin call level. Determined by the trading platform, the specific level where if your margin level is equal or below, equal or less, you won't be able to open new positions. For example, if the margin call level is 100%, this means that if your margin level reaches 100%, you won't be opening any new positions. At this point, your account is now under a margin call. Even though most new traders assume this means that their trades may be closed, that's not true. A margin call level is just a warning. Also called minimum margin requirement, minimum required margin. How to calculate? Margin call level is margin level at however many percent. Stop out level. So the stop out level is a specific level where if your margin level is equal below it, your broker will automatically start closing your positions until the margin level is greater than the stop out level. Determined by the trading platform the specific level where if your margin level is equal or less, your broker will automatically start closing your positions until the margin level is greater than the stop out level. For example, let's say the stop out level is 50%. This means that if the margin level falls below 50%, a stop out will automatically occur and the position floating the largest loss will be liquidated automatically. This process will be repeated until the margin level increases to a level above 50%. Also called liquidation margin, margin closeout, minimum required margin. And how to calculate stop out level is margin level at however many percent. Margin call. A margin call occurs when you have breached the margin call level but still above the stop out level. Occurs when you've breached the margin call level but still above the stop out level. A margin call is a warning. This is a warning telling you that your account isn't doing too well and that you are close to having your open positions liquidated at market price. If you are still allowed to keep your current positions open, but you can't open new positions. Stop out. Which happens once the stop out level has been reached. Occurs when you've breached the stop out level. This is when your open positions will be automatically closed to prevent, or liquidated to prevent, a negative account balance. Your open positions will be automatically closed to prevent negative accounts balance. Cool. How to avoid margin call. Trading on the margin is a way for traders with limited capital to make significant profits or losses. If you fail to understand the concept of margin, or not knowing what to do when faced with a margin call from your broker, you will definitely experience the shock of your trading account blowing up. Here are the 5 ways to avoid a margin call. Know WTF a margin call is. Understanding what margin call is and how it works is the first step in knowing how to avoid one. Most new traders want to focus on other details of trading, such as technical indicators or chart patterns. But little thought is given to the other important elements, such as margin requirements, equity, used margin, free margin, and margin levels. If you're hit with a margin call out of the blue, this usually means that you have no clue what causes a margin call and are opening trades without considering margin requirements. If this is you, you are doomed to fail as a trader, guaranteed. A margin call occurs when your account's margin level has fallen below the required minimum level. At this point, your broker will notify you and demand that you deposit more money in your account to meet the minimum margin requirements. Nowadays, this process is automated, so your broker will probably notify you by email or text rather than receiving an actual phone call. Know what the margin requirements are even before you place any order. Knowing the margin requirements before you open the trade is crucial. How to avoid margin calls. Know what a margin call is. Know what the margin requirements are even before you place any order. Knowing the margin requirements before you open the trade is crucial. The concept of margin call isn't thought about much by most traders, especially when they're placing pending orders with their broker. Typically, traders tend to place an order with their broker and it remains open until the limit price is reached or until the pending order expires. When you place a pending order, your trading account is not affected because margin is not applied to pending orders. However, this exposes you to the risk of pending order being automatically filled. If you're not properly monitoring margin level, when this order gets filled, it could result in a margin call. In order to avoid such a situation, you need to consider margin requirements before placing an order. You have to account for the margin amount that will be deducted from your free margin, as well as having some additional margin so your trader will have some breathing room. When you have multiple pending orders open, it can get quite confusing, and if you're not careful, these orders could result in a margin call. To avoid such a tragedy, it is crucial that you understand the margin requirements for each position you plan to enter. Number 3. Use stop loss orders or trailing stops to avoid margin calls. So use stop loss orders or trailing stops to avoid margin calls. If you don't know what a stop loss order is, you're on your way to losing a lot of money. As a refresher though, a stop loss order is basically a stop order sent to the broker as a pending order. This order is triggered when the price moves against your trade. For example, if you're a long 1 mini lot on USD JPY at a high level at 110.50 and you set your stop loss at 109.50. This means that when USD JPY falls to 119.50, your stop order is triggered and your long position is closed for a loss of 100 pips or $100. If you traded without a stop loss order and USD JPY continued to fall, at some point, depending on how much money you have in your account, you will trigger a margin call. A stop loss order or a trailing stop order prevents you from taking on further losses, which helps prevent getting a margin call. Number 4. Scale in positions rather than entering all at once. Scale in positions rather than entering all at once. Another reason why some traders end up with a margin call is that they misjudge price movement. For example, you think GBP USD has gone up way too high and too fast, and you believe that there's no way price can go higher, so open a huge short position. This type of overconfident trading increases the probability of triggering a margin call. To avoid this, one approach is to build a trade position, also known as scaling in. Instead of trading with 4 mini lots right off the bat, start with 1 mini lot, then add or scale in to the position as price moves in your favour. Whilst you continue adding new positions, you can also start moving a stop loss on the previous position to reduce potential losses or even lock in profit. Position scaling can help you magnify your profits while trading risk-free when you combine all the positions. While this usually means that you'll have to allocate more capital towards a larger margin requirement, scaling in positions at different price levels and using different stop loss orders levels means that your risk of losses on the trade is spread out, which lowers the probability of a margin call when compared to opening one big position size all at once. Know WTH you are doing as a trader. Know what you're doing as a trader. It's not uncommon to hear about noob traders who are hit with a margin call and don't know what the hell happens. These traders are the types of traders who are just focused on how much money they can make and don't know what the hell they're doing and don't fully understand the risks of trading. Don't be that trader. Risk management should be your main priority, not profits. Risk management is a big topic, which is why we cover it in detail here. So risk management should be your main priority, not profits. Conclusion. So there are 5 ways to help you avoid a margin call. Pay attention to the currency pairs you're trading and their margin requirements. Know when to cut your losses so you can trade in the day. Understanding volatility and stay vigilant of news and events that could trigger price volatility spikes that could put your account at risk of a margin call. Remember, as a trader, you should always prioritize risk management over profits. Next lesson. How to choose a Forex broker. Choosing a Forex broker will be the most crucial decision you'll ever make as a new trader. This is why you should always perform due diligence. Do DD and DYOR. Dealing desk Forex broker, non-dealing desk Forex broker, market maker Forex broker. If you've started doing any of your own research on which Forex brokers to use, you've probably come across a bunch of terms and an alphabet soup of acronyms such as DD, NDD, MM, STP, ECN, DMA, OTC, is that over the counter, LP, etc. And after coming across all these acronyms, you probably reacted with your own acronyms like OMG, WTF. If you haven't seen any of these acronyms yet, don't worry, you will. They're all over the interwebs, so you're bound to see them. It's inevitable. There's a lot of technical jargon that's used when describing Forex brokers. Some what you read or hear about are probably outdated, inaccurate, or even misleading. For example, you may have read that retail Forex brokers come in 2 types, shady, non-shady. Okay, seriously now, let's try that again. You may have read that retail Forex broker come in 2 types, dealing desk brokers, non-dealing desk brokers. Let's diagram this out. retail forex brokers, dealing desk, non-dealing desk. But wait, that's not all. Two types don't seem to be enough for the marketing folks from the retail forex industry, so they decided to use more acronyms in an attempt to differentiate forex brokers even further and make them sound fancy. Under each type of broker, new labels were conjured up. Dealing desk under dealing desk brokers, market maker brokers under non-dealing desk brokers, straight through processing brokers, electronic communication network and straight through processing brokers, direct market access and straight through processing brokers. Here's how the retail forex broker taxonomy is popularly marketed. So retail forex, dealing desk, market maker, non-dealing desk, STP, ECN, DMA. Wow, look at all these fancy acronyms. Are you not impressed? But there's a problem. This is not accurate. Here's how reality actually looks like. Retail forex brokers, dealer, market maker. Regardless of how retail forex brokers present themselves on their website or market their services, there's really only one type of forex broker for retail traders, and the most interesting part is that forex brokers are not even brokers. Have you noticed that the word broker is not used on websites of many so-called forex brokers? And for the ones they do, it's primarily for SEO purposes to help their website show up in search results on Google. Why is this? Because technically they are not really brokers. There is actually no such thing as retail forex broker. Calling a forex broker a broker is a misnomer, which is defined as a wrong or inaccurate name or designation. If a forex broker isn't really a broker, then what is it then? Whilst the image of earlier provides a hint, the answer to this question is like the relationship status that some of you might have displayed on Facebook in the past. It's complicated, but have no fear, our goal is to help you learn what forex brokers really are and how they operate. And to help explain what forex broker is, let's start with a story. How do forex brokers work? Using a story, let's learn how forex brokers work. Once upon a time, two frenemies, Batman and Spider-Man, were hanging out. They were lounging on the couch watching a movie, Justice League Snyder's Cut, but after a couple of hours their attention span started to drift. Even Batman began to get annoyed at watching himself as his character on screen constantly growled in a low, deep voice due to his bitterness of not having innate superpowers like the others. All of a sudden, Spider-Man jumped onto his feet with excitement and shouts, "Yo, Bruce, call me Batman." "Whatever, Bruce. Anyways, I have a fun idea." "Oh, I like fun. What is it?" "Let's play a guessing game on whether the price of something will go up or down." "Guessing game? You spiders are so clever." "Dude, I'm not a spider. I just acquired spider-related abilities after a bite from the radioactive spider. There's a difference. Just because I wear a spandex suit with spider symbol doesn't mean I'm actually a spider." "Sure, whatever. My batsuit's still better. It accentuates my nipples and my absolutely chiseled set of abs. Anyway, I'm interested. Not only am I wealthy, but I'm brilliant. My conjectures always turn out to be correct. Please elaborate on the details of this game." "This game works like this. Try to guess if the GBP/USD exchange rate will go up or down. Let's say the current exchange rate is 1.4. Do you think it will go up or down?" Batman doesn't trust spiders. He unlocks his bat phone, looks up the current GBP/USD exchange rate on Google, and confirms that it is 1.4. He wants to make sure Spider-Man isn't just pulling numbers out of his spider butt. "I think it will go up." "Oh really? Let's make a bet then." "What kind of bet? How will it work?" "If GBP/USD goes up, I'll pay you the difference between its price right now and whatever the price is when you decide to close the bet. But if GBP goes down, you'll pay me the difference. Payouts will be in cash. Also, you can close the bet whenever you want to. What do you say?" "Let's do it. I'll take that bet." Batman is now long 1 unit of GBP/USD. It's at 1.4. This means that 1 pip move equals $0.0001. 1 hour later, Spider-Man mentions to Batman that GBP/USD has risen to 4.1. Yeah, it's gone up 100 pips. "Yo, Dark Knight, the exchange rate has gone up 0.1 or 100 pips. Batman checks his bat phone and lo and behold, GBP/USD has indeed risen to 1.4. "Not sure how long this price will hold up. I'm out. Let's close the bet." At the start of the bet, GBP/USD was 1.4. At the end of the bet, GBP/USD was a 1.41. So the difference of is, so the difference is 0.01 or 1 cent. Gosh darn it, my spidey sense doesn't seem to work on the forex market. Looks like I lost. Your payout is 0.01. Don't spend it all at once. Spider-Man tosses Batman a penny. Batman gladly accepts the money and after having some greedy thoughts says, all I made was 0.01 profit. That type of tiny profit might be good enough for a spider, but not for a bat. If I had only made a bigger bet, I could have made a lot more money and became even more wealthier. Okay, Mr. Spoiled Batman, let's make the same bet, but this time instead of betting 1 unit worth of GBP/USD, let's bet 10,000 units of GBP/USD. But I'm not carrying 10,000 pounds worth of dollars. My bat suit is too tight. It's like wearing black skinny jeans that cover my entire sexy body. Oh, and here I thought you were rich. How much money do you have on you? Batman checks his bat wallet. I have $20, excluding the penny that I just won from you. No problem, Batsy. How about we just pretend that I've loaned you the entire amount? This way, for every 1 pip move, you gain $1. This means that if GBP/USD goes up 100 pips again, instead of making $0.01, you'll make $100. I don't trust dudes who wear tight black suits with capes, so I'll use your $20 collateral to cover the initial risk if the price falls and moves against you. Think of it as a security deposit. If you win the bet, you get it back. If GBP/USD starts to fall rather than pay up, you might decide to jump in your Batmobile and leave. I don't want to end up empty-handed, so holding your $20 as collateral will protect me. If you try to leave without paying, your $20 will be forfeited to me. Also, if the price falls more than 20 pips, you don't have any more cash to cover any losses beyond that, so I'll automatically close the bet and keep your $20. As long as the price doesn't fall below 20 pips, which is the value of your collateral, 20, the bet remains open until you tells me to close it. Okay, sounds good, but what about you? Are you sure you can pay up this time if I win again? Spider-Man flashes an evil grin. Of course, I'm an Avenger, you can trust me. Fine, fantastic, let's begin. Batman checks his bat phone and verifies that current GBP/USD exchange rate is 1.41. I'm betting that will go up from 1.41 in its current price. Here's my $20 to open the bet. Spider-Man suddenly senses GBP/USD will continue to rise, so he tries to stall let me say that again. Spider-Man suddenly senses GBP/USD will continue to rise, so he tries to stall by pretending not to hear Batman. Hello, did you hear me? Unlike snakes, spiders aren't deaf. Here's my $20 to open the bet. What was that? So you still want to open a bet? My price for GBP/USD has changed. It's at 1.4150 now. You still want to make the bet? Dude, what the hell? I thought you said GBP/USD was at 1.41. Now you've changed the price all of a sudden. That's my new price. So you're in? Better hurry before I change my price again. Fine, I'm in. I'll bet it'll go up from 1.4145. Batman is now long 10,000 units of GBP/USD at 1.4150. A 1 pip move equals $1. A couple of hours later, Spider-Man announces that GBP/USD is now trading at 1.4350. GBP/USD has gone up by 200 pips. I'd like to close the bet now. At the start of the bet, GBP/USD was at 1.4150. At the end of the bet, GBP/USD was at 1.4350, so the difference is 0.02 or 200 pips. But since the bet size is 10,000 units, Spider-Man's payout to Batman is $200 because it's $0.02 times by 10,000. Father Mucker, looks like you won the bet again. It's gone up by 200 pips, which means you won $200. With the imaginary 10,000 units that the Spider-Man conjured up, Batman has made $200. Spider-Man pays him $200 out of his own pocket and also returns the original 20 that was used as collateral. With just $20, Batman won $200, a 10 times return. Let's pay again. I think GBP/USD will continue to... Damn it, that's a back signal. BRB. 20 minutes later... Let's play again. I think GBP/USD will continue to go up, but I want to increase my bet size to 100,000 units. Oh, we got a whale over here. Looks like someone wants to trade bigger. You sure you don't want me to call you Whale Man, Bat Whale? Okay, I can increase my imaginary loan to you. My price for GBP/USD is at 1.43, but this time, since your bet size is bigger, I'll need $200 from you as a collateral. Batman hands Spider-Man the 200 he just won. Batman is now long 100,000 units of GBP/USD at 1.43. This means that a 1 pip move now equals the $10. A couple of minutes later, GBPUSD has fallen to 1.4295, a drop of 5 pips. GBPUSD is now down 5 pips. That means you have an unrealized loss of $50 because it's 5 pips times $10, which is $10 per pip. If you want, I can close out the bet now and take $50 from your collateral as payment and return the remaining $150 to you. Hell no, don't be a pest. I still believe GBPUSD will go up. The bet stays open. Okay. 5 minutes later, GBPUSD plummets. The price of GBPUSD has quickly dropped to 1.4275. You're now down 225 pips. This means you have an unrealized loss of $250. Since your collateral 200 isn't enough to cover this loss, I've closed the bet and your collateral is now mine. Thanks for the $200. In a simple story, there's a lot to unpack. For example, notice how Spider-Man literally creates a guessing game from his mind where you can make bets on the direction of the price of anything and make money if your prediction is correct. Spider-Man can take up any price he wants, can make up any price he wants. Spider-Man can move his price at any time, even when Batman is about to open his bet. Spider-Man can make any bet size he wants regardless of whether Batman has enough money. Spider-Man is always taking the other side of the bet and nobody else. This story provides a lot of hints of how trading with a retail forex broker works. In case it wasn't obvious, Batman is you, the trader, while Spider-Man is a forex broker. Notice how Spider-Man or Batman didn't actually own any British pounds. No actual quiz were ever exchanged. They were simply making dollar-denominated bets on the price fluctuations of GBPUSD. With retail forex trading, you don't take ownership of the currencies. You're basically making a bet with your forex broker on whether the price of the currency will rise or fall. Currency pair will rise or fall. The payout is the difference between the price when the bet was made and when the bet was closed. Either you or the broker will have to pay the difference depending on who ends up wrong. The risk here for you is that your forex broker defaults or doesn't have the money to pay for any profits that you've made. Let's return to the story and see how this could happen. The next day, Batman and Spider-Man meet up for breakfast. After finishing the avocado toast topped with chopped almonds and a drizzle of smoked olive oil, Batman stares deeply into Spider-Man's eyes and says, "Let's play that guessing game again. I think GBPUSD will go up today. My bet size will be 100,000 units. Okay, my GBPUSD's price is 1.43. I'll need $200 from you again as collateral." Batman hands Spider-Man $200. If you didn't realize, Spider-Man magically created a 100,000 unit position size and required just $20 of margin. This is an example of leverage trading. 1 hour later, Batman asked for the current price of GBPUSD. GBPUSD is now trading at 1.46. Booyah, GBPUSD has gone up 300 pips. At $10 per pip, I've made 3,000 in profit. I'm going to buy me a new Batmobile, or Batboat. Congrats bro, but we have a problem. What? I can't pay up, I don't have the money. What do you mean I don't have the money? But you took the bet. I did, but I didn't think I'll lose. The only money I have is the 200 you gave me as collateral. I can give you back that. WTF, what about my 3,000 payout? Spider-Man looks up and points to the sky. Look at that, it's a bat signal. The Batman looks up and sees nothing. When he looks back down, he discovers that Spider-Man is gone. In this scenario, the house went bust. Spider-Man took the opposite Batman's bet and didn't have the capital to fulfill his obligation to Batman. This is known as counterparty credit risk. Can the other party of a transaction pay? When you open a trade with a forex broker, you and the broker become counterparties of the trade. Just like Spider-Man, the broker takes the opposite of your bet. Are you sure it's able to fulfill its obligation to you? Whilst your broker makes sure that you can pay if it wins and you lose, it's also important that you make sure that your broker can pay up if you win and it loses. Spider-Man also vanished without returning $200 that was used as collateral. Spider-Man also vanished without returning the $200 that was used as collateral, so Batman also ended up losing all the funds that he gave to Ant-Man. Isn't that Spider-Man? Spider-Man ran, jumped away with Batman's money, never to be seen again until his next movie. Legitimate forex brokers would prefer to stay in business rather than go bust or disappear with your funds. Unlike shady Spider-Man, they do have ways to manage this risk. go bust or disappear with your funds. In a later set lesson, we're going to look under the hood and explain to you what actually happens when a Forex broker executes your orders. You'll learn how Forex brokers manage their risks so they don't go bust. But this is just one of several things to carefully consider when choosing a Forex broker. In order to properly evaluate retail Forex brokers, it's important to know how a typical retail Forex broker operates, so here's what we'll cover. Who are you trading with? Unlike Batman in the story above, you're not going to know who you're trading with, and even if you did, that doesn't mean you should blindly trust them. Even Batman was duped by a fellow superhero who was supposedly a good guy. Your Forex broker is a faceless corporate entity that requires you to send it money so you can open trades with it. Are you sure they are who they say they are? Is it a legitimate company that really provides Forex trading sessions, or is it a fake broker? How do you know the company won't just take your money and disappear? Who are you really trading with? Is it a reputable broker? Right, okay, so when deciding Forex brokers, who are you trading with? What are you actually trading? Notice how Spider-Man or Batman didn't actually own in British pounds. No actual pounds were ever exchanged. They were simply making dollar-denominated bets on the price fluctuations of GBP USD. So if you're not actually buying or selling, what are you trading? What are you trading? What are you trading? Only price fluctuations. You're not really trading anything, are you? You're just making bets, basically. Where are you actually trading? Notice how Spider-Man created the market to bet on the price direction of GBP USD. For Batman with just his imagination. Did you also notice how there were only two parties involved? Whenever Batman made a bet, Spider-Man did not go out into the market and search for another person to take the opposite side of the bet. Spider-Man simply took the opposite side of all of Batman's bets. As long as both agreed on the terms, real bets were made and were expected to be honoured. No one else was involved. So if you're not trading in the market, where are you trading? How do Forex brokers manage their risk? During the last bet made with between Spider-Man and Batman, notice how the price of GBPUSD moved unfavourably against Spider-Man, and he ended up not having the money to pay. Because Spider-Man is the sole person taking the opposite side of Batman's bets, Batman should have made sure that Spider-Man would be good for the money. The same concern should be made with retail Forex brokers since they operate in a similar fashion. So if your Forex broker is always taking the opposite side of your trades, how does it avoid the risk of going bust and taking your money down with it? Are the prices that your Forex broker quotes you fair? Quotes you fair. Notice how Spider-Man can quote any price he wants. Fortunately, Batman was smart enough to use his Batphone and reference a third-party data source, Google, to verify if the price that Spider-Man was using was accurate. But what if he didn't? Once the bet was made, Spider-Man could continue to make up prices in his favour. For example, he could say that GBPUSD has fallen 500 pips, even though it hasn't, and Batman will be forced to bet at a loss. So if your Forex broker is able to quote you any price you want at once, how do you know that the price you see on the trading platform are fair? Where do the prices come from? What is the quality of a Forex broker's order execution? What is the quality of your Forex broker's order execution? Notice how Batman wanted to open a bet when the starting price of GBPUSD was at 1.41, but Spider-Man declined and changed the price to 1.4150 instead. This is known as a slippage. Slippage is the difference between the expected price of a trade and the price at which the trade is actually executed. Is the difference the expected price of a trade and the price at which the trade is actually executed. Slippage can occur for a number of different reasons and can work for and against the trader. In Batman's case, he experienced a negative slippage, which is when Spider-Man gave him a worse price than expected. This results in a smaller profit or larger loss. Before being quoted a specific price, even if it's accurate and fair, means nothing if your order can't be executed at said price. How can you determine the quality of its order execution? Where orders will be executed at your requested where orders will be executed at your requested prices? We will cover these topics in detail more in the following lessons. Hello readers, do not end up like Batman. Read all the Broker 101 lessons. Next lesson, is a Forex broker a legitimate company? Okay. Yeah, I'm going to leave this episode here then. So that was quite interesting. We're now into the topics of discussing Forex brokers instead of trading, and I think we're covering how to choose the correct Forex broker for you basically. So yeah, thank you guys for watching. I will see you guys in the next episode in the is the Forex broker a legitimate company? So yeah, peace.